morning, good afternoon, good evening, and welcome to the Trade of the Month video for November 2019. And we're going to look at one of the trades from the last top 30 US equities pairs, and that was a signal that was called on the 5th of November to short Fair Isaac Corporation and go long QTWO Holdings, which is a new addition to the top 30. So before we delve into whether you would have taken the trade and what you review in order to determine whether it's a legitimate signal, let's just take a quick look at these two companies so we know what we're talking about. So Fair Isaac Corporation is New York Stock Exchange traded, as is QTWO Holdings. Fair Isaac's got about a 10.6 billion market cap, a 1.2 beta, and is based in San Jose, California. It's in the technology sector, the software application industry, and has 2,600 employees. QTWO Holdings is also technology company in the software application space, about 1,200 employees, based in Austin, Texas, and it's got a market cap of about 4 billion and a beta almost identical to that of Fair Isaac of 1.2. And let's quickly look at what they do. You've probably heard of Fair Isaac Corporation because they do FICO scores, and they develop analytics, software, and data management products and services to enable businesses, so this is a B2B business, to automate, enhance, and connect decisions. Basically, they deal with all credit scoring and payment issues for a number of businesses that need that type of thing, including banks, insurance companies, and the like. QTWO Holdings, on the other hand, it's not focused so tightly on credit scoring, but it is focused on the same group of customers with a very similar product offering, which is it provides cloud-based digital banking solutions to regional and community financial institutions in the United States. Okay, so basically they use browser-based digital banking solutions that allows them to check for fraud, enable payments, they can track disputes, they can look for risks in ACH monitoring, all of that type of thing. So you have very similar customers with a very similar type of financial product. So it's clear that these two businesses are going to have a lot of co-integration and correlation, one would expect. So let's look at that, and let's look at why these were chosen for the top 30 when we did the back test. We did the back test over 3 years, and it shows 8 trades. Very nice equity curve here. You can see top in the bottom right, bottom left corner, it goes from lower left to upper right, and we had 8 trades. Average correlation is over 80%, 81%. Fully co-integrated, 0.99 on the co-integration augmented Dickey-Fuller test. And the compound annual growth rate of those trades, which are not even over 3 years, they're over about 2.5 years, was 13%, and 26 profit factor, 13% max drawdown. They made a net about $4,500 or $560 per trade. 87.5% were winners, and what we like about this pair as well is they were reasonably quick trades for 100-day look-back periods. They were 17 days in trade. And over here on the bottom right, you can see the ratio and the moving average of the ratio, and you can see that it's flat with a lot of crossovers. These zero crossings are really important. You want to see lots of those over the back test period. So that's why we selected it. Very fundamentally similar companies with a very good back test. So what happened, and why did we get a trading signal, and would we have taken it? Well, if we delve down into the signal, let's just review that again. So the signal was on the 5th of November to short FICO, go long QTWO Holdings, and this trade exited, if I can just show you here, on the 20th of November, so 16 days in trade with a profit of $1,107.80. So it was a very good trade, fast and profitable, but would you have taken it? So let's go back to our 5th of November and see what happened in the markets. So the first thing we can notice is we go to FICO's press releases, and they did have a news release, which was on the 4th of November. They announced earnings per share, and so this signal was on at the end of trading on the 5th. So that would have given a full day for the market to have digested their earnings results. So you probably wouldn't want to go in, that's too soon, but you might have gone in the next day or the next day if the signal was still valid at that time, based on just this earnings report. if we go back to the full press releases, and I'll leave it up to you to determine whether that press release was, ahead of expectations or behind expectations. We're going to look at the share price graph in a second. But if we look a little bit further back, so the 4th was the earnings announcement. There was nothing until October 24th. So that was one of the things that may have been driving this signal on the end of trading on November 5th. And let's see what else we have. We have QTWO Holdings. So QTWO Holdings, let's just get on to their website for press releases. Let's go back from this one. So November 1st, here's a couple of things to keep in mind. Very important. Remember, this signal was at the end of play November 5th. On November 1st, they announced an acquisition of Precision Lender. Why is this significant? Well, it was a $510 million cash transaction. And remember, this is a $4 billion market cap company. And I won't show it to you, but if you look at the statistics, you can see they had about 620 million of cash on the books. So they just did a transaction that used up 85% of their cash and was equivalent to about 12 or 13% of their market cap. That's a very significant acquisition, especially when they do it with cash like that. So that would right there, that's a red flag for us in terms of would you take this trade. Now, granted, the signal was on the end of trading on the 5th of November, and that this announcement was on November 1st. So the market's already had 4 or 5 days to digest it. And that may be fine. However, when something happens like this, the first thing that happens is the merger arbs will go and short the stock of QTWO Holdings because it's the acquirer, and they'll go long. They will go long the target. In this case, that's not possible because the target was private. So you don't have to worry about that. So maybe after 4 days, this has been properly analyzed by the market and priced into the stock. But remember, it's not a very big company. It's about 4 billion market cap. Are the analysts all over this? Have they issued a note? Well, you could check those things, but they may or may not. But that's not all we have to deal with here, which is that QTWO Holdings is announcing results on November 6th, so the day after the trade was called. So that's a huge red flag. So right off the bat, you would say, I'm not going into this trade because even though the signals close on close of November 5th, there's an earning announcement coming out the next day. So you wouldn't go into the trade at the close on November 5th. However, you would keep an eye on this and say, well, if we still have a valid trade, let's say if they're announcing on November 6th, let's say end of play November 7th, that will have given the market 5 or 6 days to digest the acquisition of a private company, and it'll give the market 1 or 2 days to digest the third quarter earnings release of the company, which is probably enough, given that this is the U.S. market. This is a 4 billion market cap company. A lot of analysts cover the stock, so that should get baked in a day or two after the earnings announcement. What happened in the market? Well, let's go quickly to our share price charts. Before I do, let's just look at. We always do this in the trade review, but this is the last year relative performance of the two. And here you see the awesome co-integration. Like every time the relative performance diverges, it reconverges. Here it diverged, reconverged, diverged, reconverged. And here you see there's a big divergence recently. One would expect that that's going to reconverge at some point. But let's go quickly to our charts. So FICO, here was the earnings release, 4th of November, boom, gapped up on the open. Then the trade signal was at the end of play on the 5th. So you would want to give that another day at least. So you wouldn't have taken this trade until the 6th based on this share price movement. Let's go to QTWO Holdings. Here you have the merger announcement, 1st of November, and you can see the stock tanks a bit, which is pretty typical when they're the acquirer. But not that much. It's not that significant. So maybe this has been digested by the 6th or the 7th. But what happens here? The earnings announcement's on the 6th. I imagine after close. I haven't checked that. But given that there wasn't that much share price movement on the 6th, and then there was massive share price movement on the 7th, I would imagine that the earnings were announced after the close on the 6th, and then the 7th you got all of this price action. Is that enough to have baked in the earnings? Maybe, maybe not. What you can see is on the 8th, it had a very strong move back up, and then on the 9th again. Sorry, on the 11th again after the weekend. So all you could have done with this signal, had you wanted to take it after a pair charts review, is say maybe I could have taken this on the 8th sometime. That gives you, or after close on the 8th, because that's given 2 full days to track the earnings announcements. Now if we go to the pair charts, what do we see? So here's the signal on the 5th, 2.65 standard deviations. Here's the entry. So we were saying by the close of the 7th, everything would have been baked in, but maybe not fully the earnings on Q2 holdings. It was still at 2.43 standard deviations away, which is pretty close to your 2.5 entry. You might, if you were aggressive, have decided to take this trade if you love the setup. Otherwise, you would have waited another day at least till the close of the play on the 8th, and by then it was already tightening in to 1.77. And query whether you would have taken it. That wouldn't have hit any of our rules because we're really ideally looking for a 2.5 standard deviation entry. So would you have taken this trade? The answer is no. You would never have taken it on the 5th at the close because there were earnings on the 6th. Would you have taken it at the close on the 6th? No, if those earnings were after the close. Would you have taken it at the close on the 7th? Maybe if you were very aggressive, because you're assuming the merger announcement's been baked in, the earnings of FICO on the 4th have been baked in, and the earnings of Q2 on the 6th have been baked in. So by the close on the 7th, maybe. Okay? You would have entered, I guess, right around here somewhere. So we would have rejected this trade flat out because of the M&A and because of the proximity of earnings, and I doubt we would have taken it. However, let's look at the pair charts, and do they look good for having taken it? Well, you can see here on the plus minus chart, the entry is at exactly where all the entries have happened over the last 2 years, about 2.5, 2.6 standard deviations. So that's exactly where we like to see it at resistance. If you look at the chart, it's trending. This is a 2-year chart, okay? So it's pretty flat the last 6 months, trending slightly upwards, but because the last 6 months is quite flat, that's not overly disconcerting. We still have lots of zero crossings. What we see is it's in a channel, and it's at the top of that channel. So maybe is the answer. If we look at the RSI, we can see that even though you've got from this peak to this peak, you've got a higher high in the ratio. On the RSI, it's flat to down. And if you take it from this peak, it's definitely down, whereas all of these are up. So that you could read that as divergence, maybe weak divergence. That could be something that could lead you to say there might be a decent chance it's going to turn around. So that would be a positive as well. On the percent from mean, we can see that it's 10%, 11% from the mean. Where was it? 11.6% from the mean when the signal happened. And even if you'd taken it at the end of play on the 7th, it was still over 11%. So that's where all of these signals, not all of them, but most of these signals were generated over the last 2 years, and certainly it's a resistance level. So that also looks good on the charts. So from the chart analysis, it's a trade you want to take because it's a good setup. But from the earnings dates and that merger announcement, it looks a little bit more tricky. So we would have rejected it. However, had you taken it, you got your exit, as we know, on the 20th of November. You close your short on FICO, and you sold your shares of Q2, and you made had you taken the trade, just over $1,100 in 16 market days. So it was a really nice trade if you had taken it. However, we would have recommended you not taking it. And you can always go to your pair charts and just look at what the profit and loss did. You can see that this one came around very, very quickly and just went straight in the direction we wanted. So had you jumped in at the end of the 7th, you would have still made this full whack of profit. You would have made $1,100. So happy trading, everyone. That's the trade of the month analysis for November 2019.